What's up everybody, welcome back to the channel. So today I wanted to create a video showing you how you would actually finance a car or multiple cars through your own personal banking system utilizing the infinite banking concept. I'm an extremely visual person and I figured since you're watching on YouTube, you might be as well. So today I wanted to lay it all out for you guys. I want to walk you through the process and show you exactly what it looks like to purchase a car using the infinite banking concept. Now, some of you might be wondering, is it better than financing? Is it worse than paying cash? Well, I'm Shawn King, Infinite Banking Specialist, and today we're gonna find out. Let's buy some cars. All right, guys, so here's our car buying example. This particular policy was set up by a gentleman who wanted to deposit $2,000 a month into his policy. That's $24,000 a year for those mathematicians out there. And you can see that represented in the green policy premium deposit column. For some of you, that might be a lot. Others, not so much. But I believe once you understand how cash flows within this style of policy, you'll come to the realization that you want to flow as much money as you possibly can through your policy. So this gentleman is putting in $2,000 a month or $24,000 a year. Let's say he's actually saved up some cash somewhere, so he has that $24,000 to start off with, and he decides to dump that all into his policy right away. As soon as he does that, he's purchased himself $596,000 worth of death benefit. Now, of that death benefit, $13,921 is available for this gentleman to use right away. Think about it as available equity or the present cash value of his future death benefit. You might be thinking, that sounds like a bad deal, Shawn. What about the rest of the money that I put in? I would be kind in reminding you that you are building a bank that will gladly start printing you more money than you put in here in the next few years. But to get to that point of efficiency, the bank must be built, which means have a little patience. Now remember, this guy paid for his policy all at once, but if you paid monthly, the cash value number would be almost identical at the end of the year. You just wouldn't have access to it all right up front. So this guy has $13,921 available in his cash value. In this example, he's not going to touch it yet, but in real life, you're absolutely able to use it. If you paid annually, you have access to that total sum of cash value immediately. But in this particular example we're using here, this gentleman actually wanted to accumulate cash value so he could use it later down the road to make a much bigger purchase. He wants a more expensive car. So the second year goes by, another $24,000 premium payment goes into his policy. Now he has a total of $638,000 in death benefit available to his family, his church, or his charity after he passes. And you can see his current cash value or the equity available for him to use is $28,386. Remember, if an emergency happened and he needed cash, he can access that money at any point in time. No penalties, no problems. Now, we move into the third year. Another $24,000 goes in, and again, the death benefit increases. It's now grown to $681,000 and his cash value available is $50,858. At this point, he feels like he's accumulated enough money inside of his policy where he's finally ready to start spending that cash. So that's exactly what he does. He takes $50,000 out of the policy on a policy loan and he goes and he purchases the car. To be clear, that means he loans the money to himself from the available cash balance in his policy. It's deposited into his normal bank account with his local third-party banking institution, and then he catches himself a nice little ride down to the dealership. He ends up finding himself the car that he's been eyeballing and saving for, tells them, hey, I'll be paying $50K in cash, and throw in some of those nice WeatherTech floor mats as a bonus, because I'm about to hand y'all $50K in a briefcase. Then he drives home, and he's super excited. Now this is extremely important, so pay attention. He's just taken a loan from his private bank. And he thinks to himself, well, if I would have taken a loan from any other bank, that bank would have forced me into repayments, right? That's how that works. No questions asked. They want their money, or they're taking the car. Now that I'm the banker and I control the system, I'm not forced into repayments, but maybe I should repay myself. Some of you may be asking, why? Well, because if you don't repay, it's kind of like you're saying that the bank's money is more important than your money. And that's damn sure not the case. So even though I have a choice, I think I'll choose to repay my banking system. So this gentleman decides to repay $10,200 a year. All you folks at home trying to do the math, I got you. That's a 7% car note. So that's what he decides to do. $10,200 every single year, and he'll do that for the next 6 years running, just like he would have if he financed the car from some other third-party institution. So you can kind of see the example that we got here on screen. In the 4th year, another $24,000 premium payment is made into his account, which means, of course, his death benefit increases again, and now it's grown to $724,000, and the equity available of that death benefit, aka the cash value ready to be used, is $34,000. Now remember, this guy is also repaying himself at $10,200 a year for the entirety of the next 6 years. Now I'm sure you guys already caught this, but something unique happens in the 6th year. The policy premium deposit actually drops to $9,600. Now I'm sure at this point, at least some of you have thought to yourselves, my goodness, $2,000 a month, $24,000 a year. How can he do it? But when we think about this money in terms of a deposit and not a premium, it should make a lot more sense to you. Agree or disagree that most of us right now deposit much more than $24,000 a year into our everyday conventional banks. Think about your paychecks, whether they come weekly or bi-weekly, whether you get commission checks or bonus checks or tax refunds like a bunch of people just got, or if you're lucky enough to still get a nice little check in the mail for Christmas. We deposit so much more into our everyday bank accounts than this gentleman is actually doing into his private banking system. So it's just a little mindset shift there. But in order to maintain what he's already set up for most of his life, he decides to only deposit $2,000 a month into his private bank. And after 5 years, he also decided to decrease his deposits. Now, he could have kept his deposits the same, but in this scenario, he decides to decrease them. Maybe life got crazy, maybe someone got sick, maybe he needed to pay for the kids to go to private school because public school is getting wild right now. Doesn't matter what happened. He has the ability to decrease his deposits. That's absolutely acceptable. Remember, he's in control. He's the banker. So instead of $2,000 a month or $24,000 a year, he's down to just $9,600 a year. The important thing to understand is that even after decreasing his premium deposit amount, take a look at the death benefit number here for a second. That value keeps increasing each and every year. It's not just his death benefit though, his cash value keeps increasing, and so does the dividend he's earning. That's a huge deal, guys. So let's take a second and look at his overall net injection into his policy. What's happening after the first 8 years of his policy? So he's deposited in total $148,000. Feel free to check me on the math. He also took out $50,000 to purchase a vehicle, and he repaid himself. He played good banker. Not forced to, but he decided to repay himself a total of $61,200, which is that $10,200 over that 6-year time frame. So that leaves him with a total net injection of $160,000, meaning everything out of his pockets was that $160,000. Now, 8 years later, let's take a look at his cash value. That's in the 8th row in the 6th column. We'll take a look at the cash value available. It says $132,603. That means of the $160,000 net injection, $132,603 is still available to him that he can access immediately. But wait, don't forget, he still has the $50,000 car he bought. It's still his. It's still in his driveway. He can drive it. He can sell it. He can trade it in. Hell, he could even give it to the kids if he wanted to. But it's his, and it's been paid for the last 6 years. Now here's where it starts to get fun, guys. Cars don't last forever, right? I had this monster truck. It's gone. Sometimes you need to buy the spouse or someone else a new car. So let's buy another car. Now, here's my question for you. If you have $132,000 sitting in a private bank ready to be used at any moment, would you go down the street to your local conventional bank and try and get a new car loan? Maybe. Probably not though. You'd probably use your private banking system, right? So that's what we're gonna do. We're gonna take a new $55,000 loan to purchase our new car from the $132,000 that we have in cash value. Now remember, this gentleman's premium deposit in the third column has adjusted. He's dropped it from $24,000 to $9,600. But of course, the same principles still apply. You gotta play good banker. Every premium deposit he makes purchases more death benefit. And of that death benefit, remember, cash value available is the equity or present value that you could use today. So he used $55,000 of that present cash value to pay for his new car. Again, he decides to repay himself 7%, just like he did last time, over that same 6-year period. That's $11,250 each and every year for the next 6 years. Now, let's take a look again at the net injection after this 6-year stretch. His policy's premium deposit, or as much money as he's injected into his private bank over the last 6 years, is just $57,600. Now remember, $55,000 is what he took out to purchase that new car. And again, this gentleman, very smart guy, he played good banker and decided to repay himself just like any bank would have forced him into doing. And that repayment amount ended up being $67,500 total. So his total net injection over this 6-year stretch is $70,100. But his cash value is $218,329, meaning his cash value grew by $85,726. Now, I don't know about you, but I'm starting to like the idea of buying cars using my own private banking system. Tell me this. Did we not just purchase that car, this one right here, and actually increase the value of our private bank? Not to mention, we have 2 paid-for cars in our driveway. One of them's 12 years old, and one of them's 6 years old. You still have them. You can still drive them. You can sell them. You can pass them down. Or if you'd like to, you can do anything you want to them. You can burn them. That, my friends, is the power of infinite banking. Now you might be wondering to yourself, what in the world just happened? How in the world did our cash value grow by $85,000 and we made a purchase and we kept the car? What the hell is going on, Shawn? Luckily for you guys, we found a very easy way to illustrate that, and it's with these next 3 graphs. You see, instead of being a debtor, going into debt to purchase the car, and then working our way back out of debt to the 0 line, and then being in debt to purchase the home, and then working our way back out of debt to be at that 0 line again, or financing the vacation. I think you guys get it, right? So that's someone that we would call the debtor. To be honest with you guys, that's where most people are, even though I don't think they want to be. Now, on the other hand, you have the saver, who saves up money to purchase a car, and then purchases a car, and goes back to 0. And then they save up money to purchase the house, and then they purchase the house, and it goes back to 0. This is kind of the Dave Ramsey idea. Don't get debt, pay cash for everything, you'll be good to go. What he doesn't talk about is being the banker. More specifically, being the infinite banker. Anytime that you make purchases inside of your infinite banking policy, because the money that facilitates those purchases actually comes from cash value and not from your direct deposit into the policy, the value of your policy continues to grow, continues to get bigger each and every month, each and every year as your policy continues on. And even though you're taking loans and repaying those loans, the principal value of your policy continues to increase. And that, my friends, is what the hell just happened. With that being said, guys, if you're watching this video and you're not yet participating in the practice of becoming your own banker, but you want to learn more, do yourself a favor and head down to the description section of this video and click the link. That'll take you over to our website where you can check out our full save and spend system overview, which, believe me, will be extremely helpful in understanding how this whole concept of infinite banking works. After that, go ahead and book yourself a free cash consultation with me and my team, and we'll sit down, we'll answer all of your questions. Everybody's always got questions. We'll answer them for you. We'll discuss exactly what your goals are and how infinite banking can be the foundation to building your legacy. Please do me a favor, don't forget to like this video, subscribe for more financial insights, and check out some of our other super helpful videos on the channel. As always, guys, the information is free, but the knowledge is priceless. I'm Shawn King, and I'll catch you next time. Peace.